Hello students, we are moving to the last module, module 6. To start with, we are going to learn balance sheet. Now let us see what is a balance sheet. A balance sheet is a statement of assets and liabilities which help us to find the financial position of a concern or a business house on a particular date. Basically, a balance sheet has two sides, right and left. On the left side, you have the liabilities of the business and right side, assets of the business. Now, asset means whatever comes to you and liability means whatever goes from you. This is the point to be noted when you learn asset and liability. The next is accounting equation or the accounting statement. Assets is equal to liabilities plus owner's equity, that is capital. This means that the assets or the means used to operate the company are balanced by a company's financial obligation along with the equity investment brought into the company and its retained earnings. Moving on to the characteristics of balance sheets. There are 5 important points to note. The first one is balance sheet is a statement. That is, it is not an account. Second, it is prepared on a specific date to show the assets and liabilities on that particular date. Third, the knowledge of financial position. It gives the financial position of the business. Fourth, knowledge about the nature of assets and liabilities. And the last one, assets and liabilities tally each other. According to the accounting equation, assets are always equal to the liability. So, if the total of assets and liabilities are not equal, there is likely to be a certain mistake. So, the final position, that is assets and liability, should tally each other, which means both the amount you get under asset and liability should be the same. Now let us learn the pro forma of a balance sheet. The first statement in the pro forma is the balance sheet of dash as on dash. Then comes liabilities. Left hand liabilities, amount in rupees, amount in rupees. Assets, amount in rupees, amount in rupees. So the last column I have shown in yellow color, that should be the same. That is, the amount under liability and the amount under asset should be the same. That is why it is said that assets and liabilities should tally each other. This is the meaning of tally. The same amount should be there for asset and liability once you finish off the balance sheet. Now let us learn the items to be shown on the liability side. There are 5 things that should be shown only on the liability side. They are long-term liabilities, fixed liabilities, current liabilities, net profit and drawings. Long-term liabilities are those liabilities which are not payable within the next accounting period. Fixed liabilities are long-term liabilities which are payable only on the termination of business. Example, capital. Third is the current liability that are yet to be settled within a period of 1 year. Then comes the net profit. Net profit is the amount earned by the owner and it is always added to the capital. Add net profit. This is how it goes. And finally, drawings. Drawings are the amount withdrawn by the proprietor. So, you have to less drawings when you do the liability part. Capital, net profit and drawings are grouped together. These are the examples which comes under each type of liabilities. Current liabilities, example, bank overdraft, bills payable, outstanding expenses, sundry creditors, income received in advance. Long-term liabilities include loan from banks, debentures, etc. And fixed liabilities, capital, opening balance, add net profit, less drawings. Moving on to the asset side, the first item is the fixed asset. Now fixed asset can be divided into tangible fixed asset and intangible fixed asset. Tangible fixed asset refers to those assets which can be seen and touched. Example, land, plants, building, machinery, etc. Whereas intangible fixed assets are those assets which cannot be seen or touched. Example, goodwill, patent, trademark, etc. The second is the current asset. Current assets are those in which either in the form of cash or which can be converted into cash within a year. For example, cash in hand, cash at bank, bills receivable, sundry debtors, closing stock, prepaid expenses, expenses paid in advance for services to be received in future. They are called prepaid expenses. Accrued income. Accrued income which has been earned but has not yet been received. So it will come back to you. That is accrued income. And the last one is investment. It can be in government securities, shares of a company, etc. The next important thing to note is grouping and marshalling of data. The arrangement of assets and liabilities in certain groups and in a particular order is called grouping and marshalling. So, grouping means similar items should be grouped together. For example, cash in hand, cash at bank. So, these are similar. So, you can put these two items together. If you put similar items together, you can call it as grouping. Whereas marshalling is a little bit different. The asset and liability should be arranged in a specific order. That is called marshalling of data. There are two methods in marshalling, the liquidity order and the performance order. If you take the liquidity order, in the asset side, the most liquid asset first and the least liquid asset last, which means most liquid is cash in hand and the least liquid is goodwill. On the liability side, the most urgent first and the least urgent last. In that method, you will get that the liabilities, short notice liabilities like outstanding expense, bills payable, sundry creditors, then bank overdraft, etc. comes first. Suppose if bank overdraft is put as the first one, the most urgent, the least urgent category will be capital, net profit and drawings. Performance order is just the reverse of liquidity order. Examples are given. Please go through the example in the next slide. This is the example for the order of liquidity. Check the asset side. You have the first item as cash in hand and the last item as goodwill. On the liability side, bank overdraft is the first item, and the last item, capital add net profit less drawing. So this particular order is called liquidity. Once again, the most liquid asset first and the least liquid asset last, and on the liability side, the most urgent first and the least urgent last. This is an example for order of performance, where you can see that it is just the opposite of liquidity order. Asset side, goodwill comes first and cash in hand as the last item. And on the liability side, capital, net profit and drawings first, and the last item is the bank overdraft. Moving on to the advantages of balance sheet. It helps us to know the financial position of a business. It reflects the outcome of investment and financing decisions. It also gives us relevant information to explain the liquidity position. And finally, it helps us to evaluate the effectiveness and performance of a business. There are two major disadvantages. The first one, a balance sheet figures alone can be less informative without the data from peer companies. Second one, another disadvantage is using a balance sheet is that it does not tell us the accurate value of the company. It simply tells us the financial position. This is a sample question for you. We have already discussed this in the online class. Please draw the pro forma correctly and arrange the items under assets and liabilities of a company. Thank you, students. Thank you for listening patiently.